Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, speaking to you from New York City on this, the 13th day of June, 2017. I do like to remind you each and every week that I am the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that by going to miningstocks.com. And Chen Lin, my friend and associate, also publishes a letter called Chen Picks. Well, it's called What is Chen Buying, What is Chen Selling? You can go to chenpicks.com to pick up some information on his letter. And Chen called me just before the show today to talk about a couple of very exciting ideas that I expect I'll probably be passing on to my own subscribers in the near future. One is to do with a Peruvian remediation play, a very sizable story. I think nobody is paying any attention to it. I think it has tremendous upside potential, as does a Nevada gold play that also is under the radar of almost everyone. So Chen has a way of picking up these things at very good prices, and I'm very excited about both of them. I'll be doing some research of my own and talking to Chen some more. But again, to take full advantage of Chen's letter, you need to go to chenpicks.com. To take advantage of my letter, miningstocks.com. And I want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. Also want to thank our sponsors for making the show economically viable. Today's sponsors are Dynacert Inc., Trimetals Mining, Telson Resources, Klondike Gold, RN Resources, Novo Resources, Genesis Metals, and GMV Minerals Corp. And speaking of RN Resources, we'll be talking to Ivan Bebek, the executive chairman of that company, which I think is one of the most exciting stories out there, with not one, but 3 or 4 prospects to become major world-class mining operations. And the point is, you look at the history, and the history of this company, the executives, Ivan and his partner, have had a tremendous track record in the past of making people money in exploration plays, and I think they're back to do it again, but I believe this is probably going to be their best one. I know that Ivan feels that way. He'll be with us at about 15 minutes, or 10 minutes or so. He'll be with us to talk about what's going on with RN Resources. Anyway, I've titled today's show, It's Just as Bad as the 1930s. And as I mentioned, Ivan Bebek will be with me. John Rubino and Michael Oliver is with me momentarily to talk about some of the hot markets that he's tracking, and he'll be talking to us about those in just a few seconds. Talking heads on TV, the mainstream media are going to tell you that interest rates are rising because the economy is getting stronger and the policymakers are doing their job, and don't worry, be happy, everything is fine. On the other hand, John Williams, who was our guest last week, provided evidence that, we've really never crawled our way out of the rut that we fell into, the precipice, actually, that we fell into in 2008, 2009. According to John's work, if you look at and track inflation the same way it was measured before Ronald Reagan, we've never really come back to a positive GDP. That's because John's inflation numbers are much, much higher than what the government reports and uses in terms of talking about real GDP. And so John Rubino is going to be with me, and we're going to talk about the economy. We're going to talk about several other things. John's going to talk about the cryptocurrencies and how they are coming into play. Are they replacing gold? Is there a chance for something very major in gold, or are the cryptocurrencies replacing gold? Well, that's one topic among several others that I hope to talk to him about. John posts some videos at dollarcollapse.com. We'll talk about several of those. One of those is a Harry Dent's video, and Harry is really big on this notion of demographics, and for sure there's a lot of truth to that. But because he sees the declining baby boomer demand and the declining demand resulting from demographics, he believes that we are heading for a major depression. Well, and deflation, I might add. In other words, your dollar will increase its buying power. Well, John Williams, of course, last week refutes that, and as does John Rubino. The idea, of course, Williams and Dent would agree in the sense that the economy is not good. It really is quite weak, in fact, and it's getting worse, and it's going to get worse. But that doesn't mean Dent thinks that drives prices down. Williams believes that what happens is the government will print endless amounts of money, knocking the confidence out of the dollar, and the dollar will cease to be the world's reserve currency, and therefore its purchasing power will disappear, and prices will go up as measured in the dollar. Well, we're going to explore those ideas, but right now we want to explore some ideas with Michael Oliver. He always, Michael has his ideas, and he knows his fundamental economics as well as anyone I know. He is a free market advocate, and he understands it as well as anybody I know, but he also doesn't let that get in the way of an objective view of what the market is really doing. I know that's a sin of mine in the past. I know what I think the market should be doing according to my free market ideology. It doesn't always work that way, or at least not when I think it should. So thanks for joining me again, Michael. We want to hear what your thoughts are on several markets again. Thanks for being with us again.
Great to be back, Jay.
As you look over the many markets you keep track of, would it be correct to say that for the moment you're most bullish, perhaps, of any market on the grains?
Yeah, that's right. Last year they laid in the weeds, while gold and oil and copper, to some extent silver, sugar, had big up moves and moved the Bloomberg Commodity Index up more, actually, than the S&P went up last year, talking 2016. But that was just part of the commodity complex. The grains and meats were going down. Some of the softs were soft. The softs are cocoa, coffee, and sugar. Sugar was strong. The other two were nothing going on. Weak in cocoa. So it was an arm wrestling match. It was not a unified commodity asset category at all. And now, in our view, gold has another leg up coming soon. I think best measured by the GDX. The dollar is now weakened to the point where I'm bearish on the dollar long term. And I had my numbers for a long time that it toyed with, and finally it broke them in the last couple of months. So I think that shift has occurred, and that helps, of course, commodities. But the grains in particular, when we run our long-term momentum chart studies, not price charts, of the grains, and by the way, I throw into that rough rice futures, which are very illiquid, but they can be measured. There's a vehicle that we can at least measure rice. When you put rice, corn, and wheat together, that's 60% of the world's protein intake. Protein. It dwarfs meats, by the way. So these are three important grains. Now, also, we can lump into that the oil seeds and soybeans. So there's four markets we're watching. Corn, in our view, is broken out, did at the end of May. Rough rice did at the end of May. That leaves soybeans and wheat. Wheat is literally tinkering with the numbers intra-month or intra-week. We've got a weekly breakout number and a monthly that will trigger very long-term momentum to the upside. And if we can get one of those two remaining commodities, which look like both of them will do it, but wheat's closer, then we think you can circle the grains. And that subcomponent, which has been totally dead asleep, if not anemic, for the last 3 years at least, sharply weak 4 years ago, but then it went into the doldrums and built a downward trending price base, but a much better looking momentum base, then you can take that subcategory and say it's going to wake up. Now, often if you have very good momentum structures, such as gold had in early 2016, when you break through a structure that jumps off the page at you, when you look at it, it smacks you in the face. You treat it as if it were a price chart. And it's just so clear. Well, the grains have that clarity about them right now, from our perspective. And it says when they break out, we think that the first whoosh on the upside is likely to produce, unleveraged, a 40% move. And I think it could do it within a matter of about 3 quarters. So now you look around the world and you say, do you want to put my money somewhere? Well, the grains have been Dullsville for 3 years, or if you're probing the long side, you've been frustrated to heck and not making any money and watching the stock market go up. And so naturally, I think most prospective investor longs in the grains aren't even looking at them anymore. They've been so bored for so long. That's the kind of market that produces whooshes.
Right. Let me ask you, Michael, is there an ETF? I know there's MOO, but is there an ETF per se to play the grains?
Well, to play the grains directly is JJG, is an ETF that is unlevered. It invests in corn, wheat, and soybeans. Now, there's also DBA, which is a broader agricultural ETF. Power Shares, I think it is, DBA. There's also unleveraged. It includes the grains, the meats, and the softs. So it's a broader food category ETF. And again, they utilize the futures for their means of participation. So you don't have to go into the futures market. You can do it through an ETF. But it's our view that that's where the surprise is going to come on the inflation side. It's not going to come from gold. It's going to come from the stuff we eat. Mm-hmm. And that's the thing that has the most political upheaval impact globally. If you take the price of food up 40% in a power thrust, that's going to disturb some complacencies and turn some heads. So, but from a trader or investor's point of view, we see that as one of the most potent over a period of that time span of half a year to a year once they break out of that kind of gain. Most people would like to have that kind of gain in the stock market over a 5-year period.
Yeah, right.
I think there's a reasonable chance this could occur in less than 1 year.
Well, Michael, let me just ask you, let me just comment a minute. You mentioned that you see the grains as being politically important, obviously food. When people get hungry, you know, all hell can break loose, right? And right. So I would think that if the government, the central bank, anybody is ever under any pressure to let her rip in terms of money creation, that would be the time, which then I would suggest might have negative impact on the dollar. The dollar is weakening already, as you said. It's one of your major plate tectonics. It's broken. It's headed down into a bear market, in your view. I think a substantial bear market. What do you think the next stop is for the dollar? I saw we're around 97 today.
Well, we've been in the 96s in the recent low, and have gone dead in the low 97s lately. But while we've had this turbulence in the stock market with the drop in the favorite stocks, you know, sharply last week, which I think may be the beginning of something, but don't get too excited right away. I think it may be delayed till to next quarter before you get the downside. But that didn't have any disturbing effect whatsoever on the directionality of the dollar down and the euro up. They stayed steady, and I think that that's the main play now as the euro is going up, dollar down. Remember, when you measure the dollar, it's really a relativistic measure against other fiat currencies. So to debate it on issues of things beyond that is not important. It's always relative, one piece of junk versus another, pardon me. One piece of paper, as von Mises said, government's the only entity in the world that can take a valuable thing like paper and make it worthless. Anyway, so when you say dollar down, it's not like, something's wrong here necessarily. It's a relativistic thing.
Sure.
To the euro, to the yen, and so forth, which are equally frivolous pieces of paper. But it should have wind at the back. It should help the commodity complex have that next move up, this time joined by the half of the commodity asset category that did not participate last year.
All right, Michael, with 30 seconds left, gold, where do you might we see a breakout there sometime?
Gold's just picking its teeth here, just below 1,300. The one I'd watch the most right now is actually GDX. I usually argue the other way, that to judge GDX, you should look at gold. Right now, I have a different view. GDX is just below 23. It's been above 23 intra-week last week and so forth. But if you ever close a week out, up in much about the 23, 40, 50 area, I've got some long-term momentum indicators that say the second leg up in GDX is commencing. The first leg was the leg that took us from 12 to 31, then we pulled back, and the next leg's starting. So just about half a dollar above the market, I think you get excited about GDX again.